In today's video, we're going to talk about what you should do when you retire and all of your money's in pre-tax accounts. Because if you don't do these three things we're going to talk about, you're probably going to end up paying way more in taxes than you need to. So the three things we're going to talk about today is number one, how should your withdrawal rates change when all of your money's in pre-tax accounts? Number two, what tax strategies should you prioritize and which probably aren't relevant to you? And then finally, number three, how do legacy considerations play a role in your overall plan? Instead of just telling you what to do if all of your money's in pre-tax accounts, we're going to walk through a case study. We're going to take a look at Ruben and Katie's plan to see how did they, who had all their money in pre-tax accounts, approach retirement planning to optimize for what they could optimize for and make sure they're focused on the right things. So let's jump into their plan to see how this worked out. So here they are right here. This is Ruben and this is Katie, and you can see a snapshot of their plan. Now, as you're looking at this, whether you have $3 million in your accounts like Ruben and Katie did, you have $300,000 in your accounts or way more in your accounts, the same principles are going to apply. So as always, don't get too hung up on the numbers, but instead focus on the logic, focus on the framework so you can see how this might apply to you. But anyways, as we look at Ruben and Katie's plan, they both have a good chunk of their money, all of their money really, in pre-tax accounts. These were 401ks from their years of working that they've now rolled over to IRAs. And you can see Ruben has $1.6 million in his, Katie has $1.4 million in hers, and combined they have a little over $3 million. Now they have their home, but they're not going to live on that in terms of withdrawal rates in retirement, but here's the value of their home, here's a little bit of cash. So they have $3 million in pre-tax accounts, and here are their goals. They want to retire at 65. Both of them are 65, so they just retired. And this is what they want to live on. They want to spend $7,500 per month, and I want to focus on a couple of these line items here. So some of these are just basic expenses. $500 for auto and transport, some bills and utilities, dining out, entertainment, etc. I'm going to come back to this here because this is actually an important one, especially for people who have all of their money in pre-tax accounts. But in this $7,500 per month, they have $800 per month that's going to various charities and church for a total of $800 per month. And then everything else you can see somewhat miscellaneous here. So that adds up to $7,500 per month. On top of that, we're planning for their healthcare expenses. They are of Medicare age now, so they'll have their Medicare Part B and Part D premiums. Then they'll have an additional $4,500 per year of out-of-pocket expenses is what we're planning for. And then beyond that, they have travel $15,000 per year. Now, a lot of you say there's not a whole lot you can do with $15,000 per year. Some of you say there's a ton you can do with $15,000 per year. But what we're showing for them is they actually have one line item here for travel. If I can find it, here's $500 per month in their core budget. So call that $6,000 per year that we're planning on indefinitely. And then an additional $15,000 per year every year for the first 12 years of retirement. So until their mid-70s, they're going to plan to travel even more. These are just some placeholders here, so no need to pay too much attention to this, but I'm going to come back to that. But here are their goals that they want to plan for. The next thing that we want to look at is their income. So Ruben has his Social Security. If he collects at age 67, he'll receive $3,200 per month. Katie has her Social Security. If she collects at age 67, she will receive $2,950 per month. So they don't have that income right away, but that's what they're going to be expecting. So their net worth showed us where they are today. Their goals show us what they want to accomplish, and their income shows us what other income sources will they have to help them meet those goals. Where we want to go now is their retirement cash flows, and once we go through this, then we're going to start showing you how do those three differences in retirement planning apply to Ruben and Katie because all of their money is in pre-tax accounts as opposed to others who might be retiring. So here, real quick, is a summary of cash flows. And by the way, as I'm going through this, if you want to be able to load your numbers into the software, run through these same projections, click on the link to the Retirement Planning Academy below, and you can do so. You can input your own plan and do this on your own. Here is Ruben and Katie's income. So as we look at all this, these cash flows show inflows, so what income is coming in, compared to outflows, what expenses are going out. We always start here. So income, you can see they have nothing in income for the next couple of years. They just retired, so there's no salary. They have Social Security coming in, but not for a couple of years. So when we exclude their portfolio income, there's no outside income sources coming in here. Once they do turn 67, you see what their retirement benefits will be, and you'll see that we're adjusting that up for a little bit for inflation every year going forward. So that's their income. What we need to compare it to is what their expenses are going to be. We need to do this every single year throughout retirement. So their expenses start at $7,500 per month, which comes out to $90,000 per year. You can see if we break this down, this is just a 3% inflation adjustment every single year going forward. Healthcare is an addition to that. The reason we separate those two is because we're inflating healthcare by 5% per year with inflation as opposed to 3% with everything else. And you can see how that's broken down between their Part B premium, Part D premium, estimated out-of-pocket expenses, and then you can see that 5% jump year over year. So those are their healthcare expenses, and total expenses can be seen right here, but those are total core expenses. In addition to that, they have their goal of travel. The reason we don't lump this in with everything else is this travel goal is not going to be there forever. It has a defined end date, at least according to this plan. So we're spending another $15,000 per year for travel, and that's going to be spent until the age of 76, and then they're not going to spend that extra amount anymore. So those are their goals, and then finally they have their tax payment. This is the estimated federal and state tax payment, depending on where they're pulling money from in retirement. You can see there's a little bit of a dip here, which I might touch upon later, but this is a summary of their cash flows. What we want to do is say what are their total expenses, which you can see in this column, and we want to compare that to their total income flows. The difference year by year is what we're calling net flows. Net flows solves for what needs to come from their portfolio. What role does their portfolio play in this whole retirement income game? So you can see those numbers right here. And as we look at this right here, this highlights the first thing that I want to point out that changes when you're retiring and all of your money's in pre-tax accounts. And what changes shouldn't be so much thought of as a change as much as a readjustment of how we view things. If we look at this, and we look at their withdrawal rates each year, this is dividing how much Ruben and Katie are taking out of their portfolio divided by their total portfolio value. And so when you do that, you get a withdrawal rate. So think of the 4% rule, for example. People might think, okay, they have $3 million in their portfolio. They can take 4% per year, according to the 4% rule. That's $120,000 per year that Ruben and Katie can live on. AKA, Ruben and Katie, you can spend $10,000 per month from your portfolio, which sounds like the truth until you think about the fact that that is before taxes. So this is very different from if you're pulling all that money from a Roth account or all that money from a brokerage account. I see far too many people looking at this, seeing that number, and thinking that somehow the portfolio is going to pay the taxes for them. The portfolio, it has a limit on how much it can generate in total income. But if all of your money is in pre-tax accounts, then that total income is subject to taxes. So for Ruben and for Katie, this isn't meaning they're spending 4.4% or 4.2%. It means that's what their portfolio is generating. Then they're paying taxes, and then they're spending the difference. So as you look at your plan, we can't plan for you spending the entirety of that 4% or whatever the actual withdrawal rate is. We must take taxes into account. So in reality, it might be more like 3.3, 3.5% that you're actually spending, even while your portfolio is generating something 4% or higher, depending on your withdrawal rate and depending on how your portfolio is structured. Now for Ruben and Katie, I'm not too worried about that. And I'm not too worried because you can see here, this is where their withdrawal rate starts, but it immediately drops. And it drops because Social Security kicks in. And when Social Security kicks in, it lowers the pressure on their portfolio, or it lessens the amount their portfolio is responsible for because more is coming in from Social Security. So if I'm going to take you back actually for a second to their cash flows, I said I might come back to this here. When we saw their taxes go down, their taxes went down in terms of here's their tax payment, and we saw what they paid these first couple years, and then they went down quite substantially, specifically for state taxes. The reason for that is Social Security is subject to different taxes. They're in California. California doesn't tax Social Security. Most states don't. Even federally, when you're pulling money from Social Security, a maximum of 85% of your Social Security benefit is going to be included in that. So that's a separate tax item. But the thing I want to reinforce, the first thing here is when you retire, the withdrawal rate that you're going to take is gross. You need to factor taxes out of that. The second thing that I want to look at for people who have most or all of their money in pre-tax accounts is what tax strategies exist. Because there are some things like tax gain harvesting, or perhaps utilizing a donor advised fund, or things of that nature that probably aren't going to be as relevant to you. I'm not saying they're not going to be relevant, but maybe not quite as relevant as they otherwise would have been. What is relevant is two specific planning points. What I want to go back to here on their cash flow page is you see here, here's their income. And we looked at this. This is all coming from Social Security. Then starting in 2035, there's this pretty significant income source coming in called planned distributions. What this really is, this isn't a income source per se as much as it's a forced distribution, a required distribution from Ruben and Katie's IRA. And the reason for that is they turn 75. That's the age at which you're going to be required to start taking funds from your portfolio. You can see what that total distribution is projected to be. And you can see that by the time that they are 90, it's projected to be well over $500,000 that they are required to be taking from their IRAs. So what tax strategy exists here? A lot of people think, well, all of our money's in IRA accounts. It's pre-tax accounts. What difference does it make whether we take it now or in the future? It's all going to be taxable. Sometimes that's true if you're going to be in the same exact tax bracket today and in the future. But let's take a look at what that might look like for Ruben and Katie. So on this page, what we're looking at here is we're looking at the projected taxable income for Ruben and Katie starting today all the way throughout retirement. You can see it starts here and then it dips a little bit. And it dips a little bit because Social Security turns on. And when Social Security turns on, because that's more tax efficient, their overall tax bracket drops a little bit. And it drops until the age of 75. And at the age of 75, it spikes and it continues to grow from there. So this is part of the story. This is showing us what will their taxable income be. The second part of the story is understanding what tax brackets will that put them into. So as we start to overlay different tax brackets here, what I'm doing is I'm layering on top of this what the various tax brackets might be in the future, and you can see what that's going to look like for them. So today, they might be in the 22% or 12%, I should say, tax bracket. What that means is they have filled up the 10% bracket, they've filled up the 12% bracket in some years, and they're starting to creep into the 22% tax bracket. In the future, however, they're projected to be well into the 24% tax bracket, which if current tax bracket sunset, now may be less likely for them to do so now, but if or when they sunset, the current 24% tax bracket becomes a 28% tax bracket. So when we see this, what we can start to see is they're projected to be in a higher tax bracket in the future than they are today. So what can we do with that? Well, that introduces the concept of what's called Roth conversions. Roth conversions is essentially saying, how can we shift income that might be realized later at a higher tax bracket to today in a lower tax bracket? So what we start to look at is, well, what if they start to fill up certain tax brackets? AKA, what if we fill up the 10% bracket? Any year in which our total taxable income is less than 10% or somewhere in the 10% bracket, convert enough from our IRA to our Roth IRA to fully fill up the bracket, and now the money that we converted grows tax-free forever. That adds $0 to their plan. Why does it add $0? It does so because, as you can see, they've already filled up the 10% bracket every single year due to the fact that all their income is coming from their IRA, which fills up that bracket just as a starting point. This would be different if they were living on cash, if they were living on brokerage assets, if they're living on Roth assets or health savings accounts assets. Because all their money's in pre-tax accounts, fairly common that they've already filled up the 10% bracket. Well, what about the 12% bracket? Does that do anything? We start to see that does a tiny bit. In the grand scheme of things, not a huge savings, and that's just because you can actually hardly see it here. There's 1 or 2 years where they can convert a tiny bit because they're just under the 12% bracket. But as we continue moving here, we can start to see, well, what if they filled up the 22% bracket? Now, all of a sudden, that's pretty substantial. They have an additional $230,000+ of tax-adjusted ending assets by the time that they've passed, because what they did, you can see here's what their taxable income looked like without a conversion. The green shows what it looks like with a conversion. It's essentially smoothing out that line. Instead of being in much lower tax brackets and much higher tax brackets, how can we normalize that a little bit and find the equilibrium point where conversions make sense because it's lowering our overall tax liability? So this is one of the main tax strategies that you need to look at if all of your money's in pre-tax accounts. Because all this green that you can see here, and in fact, we can actually compare this out in terms of what does this look like in terms of year by year, what are those converted amounts? You can see that in this column. If they convert those amounts year by year, what this is showing is that the overall benefit of that could be quite substantial to them in terms of paying more in taxes today at a lower rate than they otherwise would have. So that's one tax strategy. Now here's the other one. If I go back to their goals for a second and I show you their expenses, I told you I wanted to highlight this. They're giving a good amount of money each month. And now they're doing that because they're saying, you know what, we have a paid off mortgage. Our state taxes are capped at $10,000 per year that we can deduct. We can't really itemize this. So we're just going to be giving this money on a monthly basis. Well, that might make sense today. But here's one thing that I told them to consider that they hadn't previously considered. What if we introduce the concept of what's called a Qualified Charitable Distribution? Now, Ruben and Katie, you can't do this today. You can't do this until you're age 70 and a half. But what a Qualified Charitable Distribution does, a QCD, is a Qualified Charitable Distribution says instead of taking money from your IRA, paying taxes, and then gifting to charity, what if you just gift the funds from your IRA directly to a charity? You can do up to $100,000, each of you individually from your IRAs, and let's see what impact that has on your overall plan. So here's their plan as it stands today. Here's their assets, and they're in a great place because they're not withdrawing a whole lot from their portfolio. Their portfolio is projected to continue growing throughout retirement. but that doesn't mean we can't make it better. So let's go to their monthly expenses. Their monthly expenses, let's pull out the $800 that they were giving. So let's turn this into $6,700. Now that doesn't mean they're not going to give. It means they're going to do it in a different way. $800 per month is $9,600 per year. We're now going to allocate $9,600 per year via a QCD, a Qualified Charitable Distribution. However, you can't do a Qualified Charitable Distribution until you're 70 and a half. So we need to add back in that $9,600 per year of charitable giving from age 65 to age 69 to account for that money still going out. But what this does, so nothing's changed in terms of their spending. They're still spending on what they want to spend on. They're still giving to what they want to give to. But take a look at this. If we rerun the plan based upon that simple change, that's another almost $300,000 of assets of growth they've received in their portfolio because of the tax strategy involved with doing that. So as you start to look at the impact of Roth conversions, as you start to look at the impact of qualified charitable distributions, if giving is a part of what you do, those two things alone generate tremendous value for them. And yes, they are already in a good position, but if they can do these additional things, that adds a lot more in value. So those are the two high-level tax strategies that even if all of your money is in pre-tax accounts, I still encourage you to check out. Qualified charitable distributions, that's if you give to charity on a recurring basis, that's absolutely something you should consider doing. Roth conversions, doesn't matter if you're doing charitable giving or not, that's absolutely something everyone should look at. Not everyone should do it, but everyone should run the numbers to see if it makes sense for you. The third thing that I want to look at here, so first thing's withdrawal strategies. How does that change if you have all of your money in an IRA? The second thing is tax strategies. How does that change if all of your money is in an IRA? The third thing is your legacy considerations. Legacy considerations saying to what degree does the ability to transfer money in a most tax efficient way to your heirs have anything to do with your planning? So let's take a look at that now. So I'm coming back to this page here. This is where we left off saying for Ruben and Katie, it might make sense to do some Roth conversions to fill up the 22% federal tax bracket. You can see what that does to their adjusted taxable income, and you can see what it does to their tax adjusted ending assets. Now, what we're doing here is we're making some assumptions with the terminal tax rate. Terminal tax rate could either be Ruben and Katie at the end of your lifetime, what tax bracket might you be in case you need to take out some more funds for distribution? But another way of looking at it is what will the tax bracket be that your heirs are subject to when they ultimately inherit these assets? And for Ruben and Katie, they might have a big chunk of money in pre-tax accounts. For Ruben and Katie, their children are very high income earners. And if we assume that Ruben and Katie pass around age 90, by the time that their children inherit those assets, they very well may be in the highest tax bracket. So if we take a look at this and say, okay, at 20% tax bracket, this is the tax adjusted ending value of Ruben and Katie's assets. Well, if their children are saying the 50% tax bracket because they're high earners and they're already in a high tax bracket before inheriting these accounts. And by the way, Ruben and Katie's accounts are projected to grow to about $10 million plus by the time that they pass. If you have a $10 million IRA that you inherit, under current rules, you have to fully distribute that within 10 years. Now, this is a very good problem to have. $10 million is a giant chunk of money, but you're going to have to withdraw that over the course of 10 years, which means even if that money doesn't grow at all, that's an extra $1 million per year of fully taxable income that you are going to be taking out. So when we take a look at this, if we were to refresh these numbers, this almost triples in terms of the value of the money that you generated by doing those conversions, and that's because you're now taking into account your heirs' projected tax bracket. So you can see that these Roth conversions become even more beneficial. So much so that you might look at this and say, okay, well, what if we don't stop at the 22% bracket? Does it make more sense to convert up to the 24% bracket? And keep this number in mind here, $714,000 is the proposed strategy or the proposed tax adjusted ending wealth if they convert up to the 22% bracket. If they did up to the 24%, that becomes quite substantial. Essentially what you can see here is here's our taxable income before, here's our taxable income after, and what's happening there with that big drop off is they've essentially converted all their money into Roth accounts. They've converted all their money into Roth accounts, so by the time that their children inherit these assets, they're inheriting a completely tax-free asset. Now, in reality, there's probably something in between converting up to the 22% and 24% tax bracket that makes more sense. It doesn't typically make sense to convert everything into Roth accounts unless you can do so for very little tax liability. Well, there's no in-between tax bracket between 22 and 24%, but do you convert halfway through one of those brackets? That's where the more in-depth planning, the more nuanced planning comes into effect. But regardless, you can see that even at a 30,000 foot view, there's significant value to be added there. So as you're watching this, if this is helpful for you, make sure that you subscribe, because every single week we're releasing new videos, many of which are case studies to help you see what strategies are most effective given your financial situation. So this is something that for Ruben and Katie, we were able to see how their withdrawal rates need to be reconsidered given the tax bracket that they're in. We saw what tax strategies exist, and we saw how legacy considerations are influenced by some of their own planning decisions. So with all that in mind, just because all of your money is in pre-tax accounts does not mean there's not substantial planning opportunities that still exist. If you're watching this and this is very helpful and you want to see what other tax strategies might exist, check out this video right here where I walk through the 3 big mistakes, 3 big tax strategies that most retirees miss so that you don't make those with your planning. Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.